What if you could make more money from buying and selling property in a shorter market cycle than you expected? Hi, I'm Jaryd Krause.
And I'm Sam Powell,
Yeah,
and we're the hosts of Property Powell's Australia podcast, all the P's. And in this episode, Jaryd and I, we go pretty deep into trying to help people understand the importance of data and location research. It's been a big evolution over the last few years, and the reason why it is so important for me is it's the opportunity cost of where else you can put your money. So if you can reduce that risk and amplify the potential return, your future self's going to thank you for it.
Yeah, it's basically just understanding the data to know when to invest, where to invest, how long to hold the property for, and sell it. And understand the opportunity cost. But like the things that we dig into, Sam, around like why location grows with different data, different metrics, supply, demand, but also like what happens with the growth, what pops up first, like houses and then into units. You also use Palm Beach as an example of, a market cycle and its growth rate, and then how it went crazy and slowed down, which happened for many, many locations throughout that, pandemic period. But yeah, it's very, very interesting. So yeah, also this is not the only way we can help you for free. Make sure you get our How to Maximize Your Borrowing Capacity mini course. It's going to help you buy superior assets. You can get that at propertypals.au/resources. See you on the inside. Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jaryd, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional. All right, we come to an episode smiling. We had a laugh about organization in our lives, and sometimes shit hits the fan and we can't do anything about it.
Yes. The lovely Matt from Hashtag is trying to do too many things at once, but we're definitely going to jump on with him in another podcast. But there's no point in doing a podcast with rubbish internet, is there, Jaryd?
Yeah, absolutely. And he was trying to make, he's a legend. He was trying to make it work, sitting in the dark at ridiculous time frame in a little bungalow away from the kids. Good effort on his part. So
yeah, but I thought in the essence of it all, there's a lot to just take in. So I thought it'd be good to do a session actually before we get Matt on, just to help people understand the importance of location research in property investment, because that's obviously a large data platform that we utilize is Hashtag Analytics, and I guess the definition for that is higher than average growth. If you want to have it, we'll put a bit of a link in the description below for that. But a lot of, like myself, I use it every day, and with the rise of data, it really helps to pinpoint the best suburbs within the best local government areas in Australia and give that confidence to, I guess, pull that trigger. And, you don't want to be spending hundreds of thousands or millions of dollars in a location that you think is going to go up. I'd rather, reduce that risk.
Yes, the assumptions, the old assumptions. We were going to even record this before our last episode because we wanted to get it out before Matt jumped on anyway. So it's worked out well. Location, Sam. This is, your bread and butter, really. Being a valuer. We've talked about locations in many different ways in different episodes. This one's going to be a solid one. So tell me, let's start from the top. When somebody says, like, how do I pick a good location? Like, what are some of the key ingredients?
Yeah, well, it's always understanding, like, I guess the person's current situation with budget, cash flow requirements, etc. But there's a way of going through and filtering, and that's what Matt and the team at Hashtag have actually done. Is developed a I guess they've simplified the data analytics side of, I guess, location research. And even by simplifying it, it's still complicated. It still took me months to get my head around. But once you do, it's like anything, you use it every day. It's a learnt skill, and you get better and better, and you understand how the process works. But to kick that off, look, there's a couple of key elements to location research, and where people do tend to go wrong is investing in their backyard, and we talk about opportunity cost a lot. But I guess the key things that I want to talk about today is market cycles and timing as a number one. Going in and understanding the growth potential within a location. It's like, how do you actually do that? And this is what the data helps with.
So let's just pick at that one.
We'll start from the top down and riff it.
Let's just pick at that one. So, how do we know when a location is going to pop off in terms of timing, and know what cycle it's either in or out? What sort of data do we need to be looking at for that?
Yeah. Well, I mean, generally each suburb, within a local government area, they've all got their own types of cycles, so that they grow at certain times. As an example, say you're looking to buy a property in a suburb, and it's growing in value, and it's becoming to that point where it's exceeding your budget and you're missing out. Then what the psyche of the buyer goes is what else is out there? And then they move to that next most popular destination. And what that really means is that the location they were looking into, it's up and towards its peak of its cycle, and then they're going into a location that isn't at the peak and it's increasing, as an example. So what the difficulty about it is, and the data is always a fixed number. So what Matt and the team have done is actually helped you by putting in charting and tracking those patterns of those data points over the last 30 odd years, which is really interesting. So answer to I guess market cycles and timing is they're all changing at different stages of their journey. So by going through the location research, you can identify these areas that are poised for growth more so. And the reason why we're really focusing on that is because it's ensuring that your investment aligns with the market's upward trajectory. Because there's no point in buying into a market that it's not going to see any growth, because the opportunity cost of that asset sitting there doing nothing for a number of years, it results in hundreds of thousands of dollars if you get it wrong. So the whole premise of that timing is to maximize that capital appreciation, if that makes sense.
Yeah. But how do we work out the cycles? How do we know when the cycle? That's what I'm asking. Is how do we know when a suburb or a location is going to pop off, or it's coming out of a cycle to either sell?
Yeah, well, then that goes into the supply and demand imbalance is the key points that we're looking for. So looking at, I guess, what you're trying to do is, from an investment point of view, is you're looking at risk, supply, and demand to help you try and mitigate, where those lower risk areas are to invest in that are poised for more growth. So the economics 101 is around supply and demand. If there's low supply levels and demand that's increasing, then that leads to capital price appreciation. So what we're really looking for is going, well, what is supply? So supply is the biggest risk towards capital growth, because if you've got more houses coming into that market, then the number of buyers are going to have more options. So that price pressure is not going to be as high.
What do you mean by more houses coming into the market? Like more houses being built in that area?
Yep. So you can track through, on the Australian Bureau of Statistics and all the data houses, they've got, the development application approvals that are coming through for that suburb and that local government area. So they have to lodge it, and for it to be approved, and even for the local councils, they need to commit to approving X number of dwelling approvals in that area to help them with their population growth, because every council wants to attract more people, because it gentrifies their local government area. More people come into it. It's a more attractive place to live. There's diversity and there's opportunity. and that's what people are craving. So from the investment point of view, we're really trying to go, well, we don't want to buy property in an area with, that increasing supply coming into the market. And you can, and what the team at Haystack have done is, like, you're not only looking at the current figures, but because you can see the trends over that and 6 year period, is you can start to see, oh, well, that the supply levels have been trending downwards over the long term, and it's at a point now where there's not much supply in that market, and you're looking at key metrics like days on market and seeing them decreasing. You're seeing vacancy rates decrease. You're seeing rentals start to increase, and then all these different factors lead to price appreciation. So that's the whole premise of the platform, is to really go, well, we want to find those handful of suburbs that, are diversified industries, like suburbs and local government areas with, good infrastructure projects and spend coming through in the future. But there is a good amount of demand that is increasing and over time, and you can see that through the metrics. But also the supply levels have been limited and constrained over the short and medium term. So all that leads to is just that, kicker in price. And that's what a lot of people are actually looking for to outperform the market. That's what I'm looking for, because it's essential. Like, if you're going to put your money in there, you want it to have that ability to grow. Because if you're just going off this makes sense, then what's your thesis based off? Does it, you know what I mean?
Yeah. Like, that's what we're trying to get at, is like, how do people build a thesis? And so you got the supply of houses and the demand of human beings wanting those. And then you've also got these other factors, like you said, infrastructure development, and then economic activity. How do people get the data for infrastructure development? And then we talked about economic activity as well in not last podcast, the previous podcast around macroeconomics. So I would definitely listen into that, guys. It's 2 episodes ago, so we don't need to touch on that now. But like, let's say infrastructure development. How do people get the data for this sort of stuff?
Well, it's all publicly information. It's all public. So Australian Bureau of Statistics and local government websites and even the government, they need to put funding towards projects to, I guess, continue to, let's say, appease the population and continue to grow that region. Like, as an example, for Australia to keep growing, right? Like, you think about us compared to America. Our population's like 10% of the size. Land mass is quite similar, but over time, our population does increase and has been increasing. And what that leads is to pressure on infrastructure, like your roads, as an example, is a classic example. So in order to, because land is finite, that, like, say on the Gold Coast, as an example, like, it is a built-out location if you're looking east of the highway, and you can't just go and whack in a whole bunch of supply into that market unless you're, building a high-rise apartment. But then that's where the town planning comes in. So there are limited locations that you can do those high-rise apartments. So what you're looking for, like, what that infrastructure, going back to that, is what it brings is, there's an injection of money and liquidity into that local economy. And that's to build those roads, as an example. You need people to build those roads. So you need people to come to those locations, to rent the houses, to finish the build, or to even buy the houses, to then, be there for a few years to, essentially build that infrastructure. And then that infrastructure, in turn, is, it creates easier access to that local economy. So, as an example, if you're, obviously East Coast centric, but you go from the Gold Coast, it used to be a 4-hour drive to Coffs Harbour. Now you're probably around 3. So that accessibility is a lot easier. And they've done that through road projects to do that. So then you add on.
It's easier for people to stop off in Coffs Harbour and spend money. And the more money spent in that area, the more businesses do well and then reinvest and
Yeah,
put it
and
back
then
into the
then
local
people are
economy.
looking for opportunities too, and that's where the population growth comes in. Where
Yeah.
it's like, well, there's a business to be made here. It's a nice lifestyle, so people tend to move there. And as an example, like Sydney's the leading property market in Australia because it's the most established. But with the most established comes that a higher demand for properties. So with high demand, that leads to price pressure, and that's why in Sydney median house price is over $1 million, where in the rest of Australia it's whole Gold Coast has crept up, Brisbane has crept up, but Sydney is still the major outperformer. So what you see and what you will continue to see with the rise of technology too is that the your ability to go and earn certain incomes are no longer required to be in a CBD location. Like a lot of people did live near the cities because they sacrificed lifestyle for income, in my opinion, because they wanted to have the high income because they enjoyed that challenge of a career. Whereas, if you still ask them, you're like, oh, well, where would you rather? Like, if you could do this job and have this fulfillment in your career, but live,
Anywhere
beachfront in Coffs Harbour, where you can live in that house, it's $1 million as opposed to the $4 million you're living in, that Brisbane region, then you're essentially going to have more cash flow because you've got less debt, and in the morning you can walk down to the beach and have a swim and fill your your cup up a lot more than walking out of your house and looking at a bus stop, maybe.
Which is why so many markets have changed in Australia since things becoming more digital, right? And when you explain around the Gold Coast, it's there's not much room to build east of the M1. Obviously, we can see a slower growth in that area, say, for example, against a more regional area that has a lot more space. And, people come in, they build the roads, they build shopping centers, schools, hospitals, and all these amenities that make it easier for people to go. Like, for example, a country town, they might have a doctor versus, and then now they have instead of going to the doctor, they're going to start going to the hospital and using all these other amenities, which brings money to those amenities, which helps grow the local area. So it shows why those regional people have been investing in property in those regional areas, because there's space to build and there's money that can flow to that area when you do build those amenities, right? Versus like built up locations like Brisbane CBD or whatnot, which makes total sense now. I didn't understand that until you mentioned it. Mentioned like the Gold Coast, knowing it personally.
Yeah, there's definitely a lot to it, but it's just one of those things. Like, this is the whole reason why I got into this space, right? Is because it was like, well, I can buy anywhere in Australia, but where is that best place to buy? Because like, you don't know what the future holds, right? And like in the last episode, we talked about price declines, and there's definitely always going to be a price decline at some stage in your investing journey. You obviously want to try and mitigate that as much as possible. But there's so much, the world, it's just changed so much now with all the data collection, where it's actually evolved into a more I don't think property's a buy and hold forever strategy anymore. I think if you want to play a different game, like, sure, if you just want to live a more simplified life, and it can definitely be that. But if you want to outperform, there's definitely cases to say where, with this data that we've got, that I go through and analyze, I can see because I'm looking at data that tracks all the way back to, I mean, as an example,
you can quantify your opportunity cost now, right? Like, by looking at, say, whatever properties you have in your portfolio, and then looking at the area you're in, looking at how that area is performing, where it is in the market cycle, has it been through the highest growth period in that market cycle? Like, maybe, for example, maybe you bought and they were just finishing some roads, a hospital, and a shopping center, and now you've owned that for 7 years, and you've gotten the maximum growth out of that town you can with that property, and then you can see the growth rate not being the same as some other locations, and you're amount of equity that you have in that asset, what's that going to return you staying where you're at in that property versus another one with quantifiable data and can make sense that you can grow your property further. When you also consider in the exit and entry costs as well, exiting one property and entering another property, you have to put all of that together in terms of expenses with your opportunity cost, but makes sense.
Yeah, well, like this is what you're up against, and why you should go and look into location research data, or at least employ the services of somebody who does this every day. Because it's just like anything. Yes, you can go and learn how to, I guess, fix your own plumbing, and taps, and stuff like that. But what is that? What's that time worth to you? Will you do it again? Blah blah blah. Talked about that. But like as an example, I can look back in data all the way back to 2009, and I can see from a growth perspective what a suburb has grown on a percentage basis year on year. And as an example, like with all markets, right, there's always a thing called mean reversion where it reverts back to its long-term average growth rate, which is generally sits around that 4-5% sort of target, which in Australia, like 5% would be that area that we focus. So if you're looking at buying into a market that is at the peak of its growth cycle, and I can see it like
reverting back to the average mean.
Yeah, like it's grown over 20%, in the last year, and the year before that it was growing, around 10%. So you see the trajectory go up, and you can sit there and go, well, a growth rate in like an example I was talking about previously, I'll do it again now. It's Palm Beach in Australia and Queensland. So if that had a 26.22% growth rate in the 2021 period. So that's like post lockdowns. I remember whether Jaryd was buying in that time frame or not, but it was around then, and it was insane. Like, people throwing just an extra 50 grand on top of wherever I could see comparables. But that was the market we're in. So if you're buying it in 2021, 2022, you're seeing like, well, that growth rate's peaked at that 26%. So that doesn't fall away overnight. So that gives you that confidence that, well, yes, you're paying that premium, in 2021, but you know that you're not going to go to negative growth territory overnight. So you've got that headwind of growth behind you. It's that growth rate cycle. But if you're heading down and you're halfway down the line, like say you're looking at 2022, 2023, like the 2023, the growth rate dropped down in Palm Beach to 3.76%.
Wow.
And you're like, well, the trend there is down, but there's been no indication that the market's been improving. It's still growing, so people would still be inflated confidence levels that it's going to keep growing. But if something happened in the like economically, like out of your control, you're going from a low 3.76 growth rate. You can go into negative territory pretty quickly on that front. But then this is one metric, and I'm talking like I look at 80 different metrics on this platform, and then I'm also laying over trend analysis as well. So the combination of so many different factors now, you can definitely reduce that level of risk and give you the confidence to pull the trigger, because like there's times where, like in Melbourne, Victoria at the moment, like it is at the bottom of their cycle because they've been hammered down so much. But this is where the supply and demand imbalance is so key, because if you've got a market where your rents are rising, your population continue to increase, but there's no supply, it's inevitable that there's going to be upward pressure on prices. And even if there was something to happen out of your control, like a black swan event, you can't stop that level of demand for housing, because it's not just an investment vehicle; it's also just a safety for shelter.
Yeah.
So you couple all that towards your thesis, and it gives you such confidence to go, yep, this is where I'm buying, and this is why.
So Melbourne, hey?
Yeah, old Melbourne.
I hear that, and I don't know if anybody else in the audience heard that, and it was a little hint or not.
Yeah. It's good spot. Well, like it's like so Perth at the moment, just bananas. It's the outperformer. You know, that's not going to dissipate overnight. It never does. But like generally, property, like everything has its own cycle, and property does have its own cycle. So, like an area like say parts of Perth, like I'll on this example, I'll use Palm Beach, right? So over the last 5 years, Palm Beach has gone up 62.22%. You know, so yeah, like, and that's a really strong growth rate. When the mean of growth sits around 5% for the suburb, it's like wow, like that's really strong. But you go back and go, well, before that 2019 period, it was just slow increase over time. So it underperformed on those few years prior, and especially from like 2009, there was pretty much like, I'm just looking, the growth rate was like it went negative throughout 11 and 12. So it pretty much didn't do anything from 2007 to 2013, like in regards to price.
Our good mate Camo will be listening to this and laughing when he bought in 2017 in that area.
Yeah, but like the way I counter-cyclical, and it's just like trend analysis, used to sit there and go, well, it's done nothing for a good part of 5-10 years. That's not, and this is where some investors go wrong too, is they look at the 10-year growth rate going, oh well, like last 10 years it's grown by 170%, so it's due to grow, like that's the standard for the suburb. And I was like, no, it doesn't work that way, because the long-term average for suburbs in Australia sits around that 5%, 6%. So if it's had a cracker of a 10 years, it might continue slowly for another 5 years and then stagnate and do not much, because it's always based on like what incomes can support, I guess, the prices.
So I got a couple of questions here. That's awesome. I love hearing all of this. we had some other things completely planned for this pod, but we're just diving deeper into this. And so my questions are: is Palm Beach, what would your assessment be of how it cools off over what time period? And then it would be once we answer that one, it would be, what's the average time? And this is going to be a tough one to answer because every single cycle is different and times. But what would be the average time that somebody might want to hold on to a property through the growth rate of a cycle before selling on average? But let's get to the Palm Beach one first. Like, what's your assessment on where you believe, just as an example, because there's been other areas in Australia that have gone up like 30 to 60% as well. Right? Like, how do you see this slowing down?
Well, Palmy has already started to slow. You can see that. It's at that stage where, like, because you can get second kicker in growth rates in their cycles. So, like, it's depending on so many different things, but had a really strong growth run. Like, where I'm looking at more in the macroeconomics cycle is that I still see growth coming through to Palm Beach, but I can see the growth coming through in most of those, well built out, established areas that have that high desirability for people to live. It just gets to a stage where, it just becomes less affordable, but then you'll start seeing that sort of more prestige market come in, knocking things down and doing new builds.
Right.
So where I see Palmy is, well, it's where I see the global economy, and that we're still in a bit of a housing shortage. The trend for sea change is still present. We've got the baby boomers downsizing out of locations in more established markets like Sydney and Melbourne. Like Sydney especially, they can go and sell their multi-million-dollar home and then go and buy in a location that's near the beach, has a stronger lifestyle, and can still see growth out of that. So Gold Coast is still positioned quite well for the next 10 years, in my opinion. But it's that's fueled in the back of, well, Australia as economy is positioned really quite well because of our ties with international markets. Like you got the rise of the Indian nation where their population is so strong. They have a lesser of education, but their population growth is extremely high. And as a migrant, I guess, country, we're welcoming a lot of educated migrants to come in and bolster our economy. So that's really strong. And then you go into our Chinese relations. China's got a problem with, they're going to have a problem with population in the future because they've had that one child policy. So they've got an aging demographic similar to Australia. But the issue around China is because it is the communist nation that there's less of a desirability for people to migrate there. So they won't, like, their population comes from natural increases, whereas ours comes from external. And then that's what gives me more confidence in Australia as an economy because it is a really desirable place to live. It's really safe. We've got good incomes and we've got good lifestyle. So outside of that, that's like going to Palm Beach, like Palm Beach, Gold Coast, right near the beach, high desirable like location. I mean, your typical house price sitting there is around, at the moment, this is crazy, 2.185 million. That's really strong. Like, would that grow as much as other locations? No, because not everyone has the ability.
Mil or a borrowing capacity of a 2.18 mil, which is what you always say is like those lower to entry properties in terms of price range that are more affordable for more people, which is why they typically have a high growth rate because the demand is typically higher than the demand for buying a $2.2 million home.
Yeah, like if I was looking at Palm Beach, I'd be more inclined towards units. Even still, units have a typical price around 1.2 million at the moment in Palmy. But that's why, like, it was a really great place to buy, a year ago. But at the moment, we've seen really, really strong growth in the units coming through, and that's generally how the trends start to work. Is like the houses kick first, and units tend to follow because it's affordability.
Oh, that's cool to know. Yeah.
But it's always selecting the right types of units. Like units get piled into like a duplex, which is one of two, is classified as a unit. But the scarcity element of a duplex is so much greater than a high-rise unit, which is also classified as a unit. You'll get rubbish growth, and if you get growth out of a high-rise unit, well done. But I'm going to tell you, the only reason why you're getting it is because you're in the really strong growth cycle for the economy that you're in
that location, right? And then stacking that up against another growth location in a more rural area, there's opportunity cost possibly lost, right?
Oh, massively. Like if you want good depreciation, as Mike said when we had him on the podcast, Mike Mortlock, back in the day, buy a unit, you get great depreciation out of it, but you'll get rubbish capital growth, and I mean that's the whole thing, right? There's so many different moving parts and elements to this. It's it's a full-time job to keep on top of.
Yeah. Before we sort of like run this one out, I've still got heaps of questions, so we can just maybe do a part two after we speak to Matt from HTAG. But the cycle, like what's the rough length of a cycle? I would say from like something coming out of a low or flat period to getting growth to like having a bit of a blow off top sort of scenario, investing terms or stock market terms, I guess. And then before it sort of like decrease, like at the top of the bell curve. Is it similar with a lot of markets, or is it?
It's all about volatility. So some suburbs are more volatile than others, and therefore they have more peaks and more troughs. So you can
just like some human beings are more volatile than others and have more peaks and troughs.
Exactly. I don't know. Analogies like everything has a cycle. Like even from the leaf that you're stepping on.
Human beings have cycles. Men's is one full cycle a day, and women's is 1 month.
Yeah, that's a really good point. So like it's always case by case. you can look at like past performance, not an indication of future performance. So like, as I mentioned in one of the last pods, was you can have areas like your Bendigos that haven't seen any negative price growth since 2009. You could look at that and go, oh, well, that's a really, sort of like stable market. It hasn't had any negative price growth, but then you've also had the extra element now of the rise of these buyers agents that are buying around Australia that they might have flooded into Bendigo, and you've gone from a strong, diverse, high owner occupier suburb to a massive influx of investors, and then during that harder economic time, all the investors throw their hands up and sell it, and that leads to rapid price appreciation. So this is why location research is so much more important now, is because I feel that those booms and busts of certain locations could be amplified with the rise of inexperienced buyers agents that are just all piling in, and it's that herd mentality. So I'd rather be ahead of the curve, and that's why we utilize and spend a lot of money on data and research to do that.
Yeah, absolutely. Awesome. Thanks, Sam. Everybody who's listening, thank you for listening. I'm sure just from this pod, it's just stoked a lot of questions within you. So send them through hello@propertypals.au. We want to answer these questions for you around, like data for locations, cycles for locations, even just the things that you mentioned around like units versus houses being, you first to grow, and then once it's tapped out there, then it moves into the units. Just all these, just little things, but just mean it's just so much value. So guys, get your questions in.
Yeah, and if you have any questions for Matt, who's coming on in a couple of weeks after this, put them in, and we'll try and include them, because I've definitely got a few meaty questions. And
yes.
Let's learn.
What is it? It's HTAG, so people can go check it out. HTAG.com.au.
Yeah, we'll put a link in the description below. It's probably easier, but HTAG Analytics is the data platform. If you search it, you'll probably come across a lot of hashtags on TikTok, so it's harder to find. But click on the link, and we'll go from there.